Hi, everyone. My name is RJ Foltz. I am with Stock and Option Solutions with by All Shares, and welcome to Global Equity Across Borders. Um, so we're excited about our discussion today, and we have a good panel here. So just want to introduce myself again, RJ Foltz. I'm with Stock and Option Solutions. I've been with Stock and Option Solutions for a little over 8 years. I work in as our implementation manager and onboarding manager. But I've been in the industry for a little over 20 years. So have seen a lot, and we'll talk about a few things today. And I have a few colleagues and another colleague from All Shares here. So take it away, Nicholas.
Yeah, hi everybody. My name is Niklas Dahlqvist, based in Finland in the Nordics. Been working with incentive plans and at All Shares for 16 department for our clients in Europe. And besides that, I'll be also involved with sales, work on how our clients work with their incentive schemes. So broad knowledge of how incentive plans especially work in the Northern Europe atmosphere.
Yeah. Thanks, RJ Nicholas. And my name is Amit Majumdar. I look after the equity management practice in Qapita. So excited to join you folks on today's discussion. My background's been in equity compensation. I used to be based in Australia. Now I'm based in Singapore. So over the years I worked in the industry, have seen quite a bit. So RJ, not too dissimilar as it is in your case. I think our goal today is to share a few stories and a few things to keep in mind as more and more companies are increasingly looking to offer equity across borders. So there's a few things to keep in mind from design, taxation, cultural nuances as well. So I think today's session is we're going to aim to cover and address those aspects from our experience. So what we wanted to do first is we want to take a look at the big picture. So obviously we're not going to be in position to cover every single jurisdiction there is in the world, but we want to focus on a couple of key regions. And we'll kick things off with what we've been seeing across Asia Pacific and Oceania. There are a couple of countries that are quite popular for international companies in terms of hiring talent. So I wanted to run through and give you highlights for 6 jurisdictions that we've picked. So starting off with Australia. So a place where I used to be based for a while, but it's also been in the news recently for upcoming changes that are being considered to the capital gains tax regime. So if you're familiar with Australian share plans industry, it's been around for a while, and there's a few specific tax advantage plans that exist both for public listed companies as well as for private companies. And I guess the one thing you need to remember if you have employees in Australia is that the key requirement has to do with the employee share scheme reporting. This is a requirement for the companies to issue a tax statement to the employees participating in their share plans, as well as complete reporting to the ATO, which is the Australian Tax Office, every year. So, this webinar is happening in the month of July. So the key deadlines you need to remember is that 14th of July was the deadline for the statements to be provided for the employees, and 14th of August is the deadline to complete that reporting. So if you have employees in Australia, this is something to be mindful about and double check on your requirements to complete that reporting. That's definitely number one priority for anyone with employees in Australia. When we think about the kinds of incentive programs and equity plans that can be offered for the employees in Australia, they differ from those that take advantage of the startup concessions, which generally requires the companies with a limited history in terms of since the years in incorporation and meeting certain obligations. So this is usually relevant for Australian startups. Having said that, there's many different ways you can structure plans with the deferred tax regime in place. Having said that, like any country, there's always some interesting nuances that come into play. So Australia and New Zealand love their loan share plans, which we don't really see in other parts of the world. So that actually provides the ability to, have shares held on your capital account rather than taxed as income. And there's many different mechanisms to salary sacrifice to contribute salary, like it is the case in many ESPP, employee share purchase plans, but it can be designed in quite a unique way in Australia. Singapore, where I'm based now, is also unique in its own way. Generally, it's a pretty friendly country in terms of the legislation, in terms of being able to offer equity, but has a pretty interesting approach to tax sourcing. So, important thing to keep in mind is, Singapore being a regional hub for a lot of multinational companies, you have a lot of expats. So, giving equity and having those individuals leave the country, even on a 3+ month long assignment, can cause a trigger for what's called a deemed exercise rule. So effectively, from Singapore's perspective, you'll be taxed on exit for both vested and unvested equity, even if it's subject to restrictions. So that's something important to keep in mind. And for, like I said, a regional hub with a lot of expats, this is definitely one key thing to remember for that jurisdiction. But beyond that, Singapore is quite friendly. You can do quite a lot. Options are quite popular. They can be discounted, nil cost as well. So you have a lot of flexibility in terms of offering, equity incentive to your employees. On the flip side, there's a couple of jurisdictions that are a little bit more tricky for various reasons. And, China is, I think, a famous example in the share plans world globally, with the requirements for China safe registration. So, exchange controls are pretty tricky. So if you want to reward your employees with equity, especially if you're public listed companies, there's a registration process you have to comply with, opening relevant bank accounts and how you move funds in and out of the country. So for that reason, it tends to cause a few headaches to ensure you comply with those registration requirements. On the flip side, if you're a private company, this becomes even more complicated. And for that reason, we see a lot of companies offer cash settled FANTA programs for the employees in China. So unlike Singapore, when things are pretty flexible, in the case of China, things are a little bit more tricky. Another common jurisdiction for a lot of companies that have, talent and teams is India. We increasingly see more and more companies opening offices there. So in India, there's also a few specific quirks and nuances you need to remember. Obviously, RJ, we're going to talk about the US and a lot of requirements there, and Section 4A, Foreign Evaluation Reports are quite famous, and everybody seems to have a pretty good grasp. But there's also a specific evaluation requirements in India, and it is a valuation that has to be issued by Category 1 merchant banker, and that valuation is required to set FMV to calculate your income tax for the employees, especially, for example, when they exercise your options. So it's important to ensure you are aware of those requirements. India also has a specific exchange controls and compliance for cross-border payments. So this usually can become a little bit tricky as well. One thing that we're going to talk about a little bit more when we talk about employee expectations in different jurisdictions is the increasing trend of actual liquidity programs in unlisted space in India. We're seeing so many different what we call tender offers in the US context, or liquidity programs, or ESOP buybacks in the context of India. We're seeing a lot more activity. So that's something important to keep in mind if you're considering, or currently managing equity plans in India. Philippines is another jurisdiction when we see a lot of companies setting up local offices and hire the team. But it doesn't come without its own challenges. So SEC registration exemption requirement to offer equity settled awards is present. And once again, similar to the case of China, it usually proves to be quite tricky. So a lot of companies, go down the phantom or cash settled path. So that's something you might need to consider in your cases. And the final one, Vietnam, another great talent hub that we see a lot of companies take advantage of. Well, once again, State Bank of Vietnam requirements are not the most friendliest, even though they were changed in August 2025, so a couple of years ago. Unfortunately, we haven't seen too much positive developments as a result. And once again, because of these requirements, cash settled and FANTA plans is something that multinationals do need to consider a little bit more. So once again, don't want to go through every single country and jurisdiction that is there in APAC. So Nicholas, maybe I'll hand it over to you and give us a few highlights from Europe and the Nordics.
Yeah, sure. Thanks, Amit. So in general, if you want to sort of speak generally about the Nordic countries, I think there is quite a big interest in making your own investment into this plan. So it's quite common in the Nordic region that the companies actually require that the employees themselves make an investment. Amit mentioned the ESSPs or ESPPs that are really common nowadays in the Nordics as well, where the employees are actually, although that they're not only in the Nordics but a global company, that you require that the employees are finding their way to invest in those plans. But if you want to talk about country-specific things, for example, Sweden has quite a big employer social security liability. So if there would be a company that wants to come into the Nordics in general, but especially in Sweden, you might see that there's a quite hefty price if you want to offer stock options, if you want to offer share plans in those countries. Then, of course, there are certain Swedish-specific things. For example, the Leo law that we talk about, where according to the Swedish Company Act, it requires that the company has 90% vote from the AGM in order to sort of pay out shares in the matter. From administration perspective, maybe what is really common in Sweden is what we call in Swedish kvalificerade teckningsoptioner, or in other words, qualified option plans. And that means that regardless if it's an option, a minor company or a bigger platform or a vested company, that company might want to give out qualified stock options that are specifically incentivized for Swedes. So there might be differences in if you're a Swedish company and want to offer global equity, they might want to offer that part, the KTAs, only for the Swedes, and then something else for other jurisdictions. When it comes to Norway, it's really, or this is quite similar for all the countries, but it's a really strict legislation that if you're a Norwegian, you must have your sort of equities or whatever incentive plans you have, they must be within some kind of data system that is protected by the Norwegian law. So what we call is a corporate, according to the corporate law jurisdiction, all vested equity must be instantly registered through the Norwegian Central Security Depository. So it really creates the issue that it's quite strict in a way when you want to give out equity in Norway, especially when it comes to Norwegians. There's also the wealth tax valuation trap, which means that unlisted companies face jurisdictional audit risk regarding how they report share valuation to Skatteetaten, which is the sort of tax administration of Norway. And then, of course, from an administration perspective, as mentioned, it's actually really important that all securities are registered at Euronext Securities, or the VPS. So if you're a Norwegian, you must have your Norwegian stock options or share plans in a Norwegian account. When it comes to Denmark, 7P is maybe something that is worth mentioning. So Danes especially, or people based in Denmark, whether or not they're Danes or not, they might want to have the 7P tax advantage plan. What that means is that it's actually a written agreement between the employer and the employee that when a plan vests, there will be a quite significant tax burden, or that will be waived from the employees themselves. So that's really key. And similar to Norway and Sweden as well, it's actually expected from the companies that they are registered within the Danish corporate law or corporate agreements. So what we are seeing commonly here is that it's quite sort of strict in a way that if you want to offer equity within Sweden, Norway, Denmark, and Finland, where I'm coming to, you have to be registered in those places by themselves. Then in Finland, if we want to talk about that lastly, we have what we call transfer tax, which means that if you purchase or you receive stock options, if you receive any shares from a stock option plan, you have to pay 1.5% transfer tax on top of those. So that's something to be considered as well. And of course, then if you want to offer to a broader audience, some kind of share-based plan or some kind of equity being a Finnish company, you have to offer that plan to more than 50% of the personnel. So you cannot just go and tell the management team gets a 20% cut off the share price. It has to be offered to everybody included. And similarly to the other countries as well, the Finnish tax administration expects digital tracking of all asset disposal and benefits. So if you want to conclude what we have discussed about the Nordics, it really says that, yes, equity is quite common in these countries, but there are some restrictions and things you need to follow as a company when you enter that. Over to RJ.
Yep. Thank you, Nicholas. All right. Let's talk a little bit about North America. We'll kind of split these up between the US and Canada. There's a lot of considerations, especially with the United States. Uh, the I think plan design has a big impact on kind of the accounting principles. We see this a lot with ESPP and um, employee stock purchase plans and how they're designed can have a really huge impact on um, tracking expense and and reporting on ESPP shares. But accounting is a big piece for um, all of the equity and getting those books closed in a timely manner. So um, uh, all of our clients, accounting is a big piece. So we're working with their teams a lot, making sure they're getting what they need. Um, just administration considerations, just in general. Um, it's really a lot also compared, like where does the equity administration fall within the teams? Whether is it HR, is it legal, is it accounting, is it payroll? And we see the equity admin handled by each group from different companies. So there's not really a one rule this is where equity should fall. Um, but the majority, I think the last stat I saw is that maybe around 80% of clients um, handle their equity administration within their HR teams. But I think the main um, importance here is not to be siloed with the administration. Um, we, as I'm our implementation manager, onboarding manager, um, I do see that sometimes where you have different groups within an organization where they're not talking to each other. And so um, it's hard to collaborate in those scenarios and things can get missed and not sure like what's upcoming. And so I think as a stock administrator, whether you're doing that internally or um, you are outsourcing that, is really you're almost becoming the quarterback role where you're bringing the different teams together to make sure that the equity administration, all groups are touched, and know what's going on and how the processes are going to work. So I think that's a very important piece is that the stock admin really does have to be the quarterback bringing the teams together. Um, the other considerations, you have your different tax thresholds for your federal, your locals, potentially your Medicare, and so that's a important consideration. And what we do see a lot of times for companies to make that process not as manual is they will work on um, setting up automated file feeds from their payroll vendor directly into the equity platform so that data is up to date. So if there are stock option exercises or restricted releases, that the taxation is going to be accurate. So that's an important piece for their taxation on their equity. Local tax, this is always a more challenging one. There are um, ways to handle local tax in the different equity platforms. Sometimes they're easier than others. But just in general, getting that information from payroll into the equity platform so the local tax is withheld accurately can be a challenge and always leads to a more making sure that that's audited and handled correctly. Um, I do see there's sometimes clients don't handle the local tax and they just maybe do it through payroll or maybe even the participant handles that themselves. Um, some other considerations for the U.S. Retirement eligibility. Um, this one is a kind of a surprising one is that a lot of our clients that we're onboarding may not even realize or understand what retirement eligibility provision is, what the regulations are around that. Part of my role during that process is making sure the clients are aware, and I'll send them information on that, around that, to see if they have a provision. If they have a provision, are they taxing correctly? So it's an important one that a lot of clients aren't even aware of. So SEC reporting, this is a big one. This is for your Section 16 C-suite population, and their filings or Form 4 filings. It's a timely filing that has to be done within 2 business days. And really trying to coordinate those upcoming events, and making sure you're planning. And this is typically handled by a team's legal team. A lot of times, the legal team will actually use a third-party vendor to track that. But this is an important one, and definitely something that is well within the stock admin portion, and make sure you're coordinating with your legal team. So the other one is the IRS 100K next day rule for submitting your payroll tax on any activity with that has over $100,000 worth of income, and that tax submission has to be done the very next day. A lot of times, clients may not realize that's due, or how that calculation is done, but it's an important one. This is with this 100K rule, and that next day payment has to be submitted. We are seeing more clients move to a prior day fair market value calculation for their restricted releases, to give additional 24 hours to help with that tax calculation. They'll know that fair market value 1 day in advance, and it just gives them more time to be able to calculate tax, submit the payment to the IRS. Actually gives more time also for your Form 4s preparation, and getting those submitted as well. Another is mobility taxation. In the US, I saw a stat where roughly only about 15% of the companies are accounting for state-to-state mobility taxation. However, for the US companies with international participants, we see a lot higher percentage of companies that are accounting for mobility between country to country. The equity platforms out there, there are some that can support that, some that cannot. And I've seen just even internal managing that process, or working with a third-party vendor to help with those calculations. But me personally, I have not seen an equity platform that can support that whole process that great. So certainly an administrative challenge there with mobility taxation. For Canada, typically there's your federal tax, and then there's your provincial tax. Most of the time, what I see on that is a company will have a combined rate there, and it's usually at the highest rate. And then the participant won't have any refund when they are doing their taxes with that calculation. Another consideration is the vesting during notice periods. So this is typically when between a termination, and it's a period between kind of the notice versus their last date, and kind of how that is handled. And I think the equity plan rules really have to be defined. Otherwise, you can have scenarios where a person or a participant will still have a vesting occur, and and they are due that even though they're technically terminated. So it's something to consider and make sure that your plan documents. I know a lot of companies will have older plan documents, and with that, the language might be more vague, and so um, it's just something for your legal teams to make sure you're reviewing. Is that language updated? Are your plan documents updated to for that rule? Those plan docs really have to be very specific upon everything that is occurring in the process upon termination. And then for the federal framework, this is really for any federally regulated employees where if you have over 100 employees, the company must have a employment equity plans to consider there. All right, we're going to move on. So we're going to talk about employee expectations for each of us. So we're going to go through that. So we'll start with Amit. No, I'm sorry, Nicholas, I think you're up.
Yeah. Thanks, RJ. No, quickly, employee expectations. As just mentioned, I think the employees in Nordic do expect that there is an equity plan when they especially become an employee or are an employee of a stock or a listed company, meaning that there are not that many companies that wouldn't offer some kind of LTI or option plan for their employees. From probably a Swedish perspective, I think it's quite common that the Swedes expect some kind of broad-based plans that require some what we call skin in the game. So they require some kind of own investment, regardless if it's a matching share plan where you buy options from the stock, or sorry, shares from the stock market, and then you get some kind of performance shares multiplier in the end, or if it's a KTA, as mentioned, just with the stock options. Regardless of what it is, the Swedes do expect that there is a broad-based plan for a majority of the employees, and that there will be some kind of skin in the game as well. Then, secondly, of course, we live in a quite digital world nowadays, which means that bank ID integration is something that Swedes do really expect. So bank ID is sort of a way of logging in with your banking codes into any system. And for example, what we have at All Shares is a bank ID integration into our system. So if you're a Swede, you can log into our system with the bank ID integration. Then something specifically of Norway, I think the Norwegians, what we see in our results when we collect data is that they really expect transparency between the company and the employees when it comes to equity. So if there would be any things that wouldn't be sort of straight out for the employees, or they wouldn't get the information needed, they are quite common that those employees will be hearing themselves. So maybe if you want to call hiding something, or you decide that, okay, I don't want to offer a plan for the Norwegians, or there might be disparity between groups, I think the Norwegians do find that out, then they expect some kind of transparency. Then, as also mentioned, Norwegian wealth tax. So the employees do expect that since there are some kind of or there are employee stock options that do come as qualified, and in a way may make your taxation more beneficial for yourself. The employees of the Norwegian companies do expect that the administrator will assist them with the tax questions that come aside. Then from a Danish perspective, there are quite similar findings that we have as it comes to the Norwegians. They are very literate in, and what I mean by that is they actually do understand the stock options and the protections that they have from the labor law. So that's something to consider really in Denmark, that the Danes expect that the company that offers them equity will follow, for example, the 7P as mentioned, and also if a stock option, for example, becomes vested for the employee, that employee by law gets to keep that. So they're really strict with that. And then when it comes to probably Finland, clarity over hype. So I think Finns, what we see in the market is that Finns really do expect some kind of high trust partnership between the employer and the employee, but also with the administrator. So the things are really sort of low tolerance for ambiguity, if you want to call that. And then, of course, what Finns has also mentioned, just what they offer is a broad-based employee share issue. So if you would be a Finnish company, or if you would be a company planning on doing some business in Finland and growing your business there, you might consider having a broad-based employee share issue, which gives the employees some kind of minor discount, 10% discount on the stock options or the shares offered within the issue. But in general, transparency is something that is really expected in the Nordics between the employer and the employee. And as mentioned, also broad-based plans are really, really popular in the Nordics, where a majority of the bigger players here do have one.
Great.
I think we can probably all agree that, a bit of transparency and more broad-based employee ownership is probably a good thing
Yeah.
that more and more countries should follow, right? But when we think about, I guess, Asia Pacific, that may not be the case, consistently across the continent. And I think it's predominantly driven by what individuals have experienced in their own careers and kind of seeing the news, like what's been happening in the industry. So I think we can kind of look at different pockets within the region. So in Australia, obviously, there's a lot of attention to exits because of the CGT talk that's been happening the last couple of months as well. But the other aspect to consider, there's been quite a lot of exits happening. A few success stories of successful Australian, especially B2B enterprise software companies that had a chance to list domestically on ASX or even in the US. Quite a bit of M&A. So a lot of people who received equity in unlisted space have had a chance to participate in those exits. And I think, what we'll talk about a little bit later is that more technical is a lot of companies may be starting in Australia, but like flipping to UK or US, which is pretty common as well, and then running more US-centric tender offers. So exits are becoming a little bit more prevalent and common. There's enough kind of case studies around to keep an eye. So pretty decent understanding. So I think similar to Nordics, a lot of Australian employees have had a chance to participate in various share plans. Could be in a listed company, could be in a startup, and kind of expect that to be part of their compensation. When you think about other parts of the world, so in Southeast Asia, it's kind of the opposite story. So there have been predominantly like a lack of exits in recent years. Yeah, look, M&A is happening, but IPO market has been pretty quiet. So for a lot of employees and some of the jurisdictions, there may be a preference for cash because maybe lack of understanding what equity does, or there's no enough examples around them to see it's like, oh, what does it actually mean for us in practice? So in all the regions, you're always going to have executive compensation. So Nicholas, you're talking about like long-term incentives, short-term incentives. So that's usually pretty vanilla setup for a lot of companies that comes in many different shapes and forms. But for broad-based plans, in Southeast Asia, it's a little bit inconsistent. All right, so in that reason, like for you as a company, if you're looking to hire in Southeast Asia, you want to just understand what are the local preferences and nuances and what actually makes sense. And we talked about earlier in the some jurisdictions, things are a little bit more tricky, right? So if you're running a global broad-based equity plan, maybe the cost of compliance in certain jurisdictions may not be worth it for you. So maybe providing a local kind of cash or deferred cash or phantom program instead may make sense and something that employees will be quite happy with. So important to keep that kind of a exit lens and context in mind. And I think India is a very interesting case because it surprised a lot of people, but a couple of years ago in 2024, like India was #1 in IPO league tables globally. So not like Hong Kong, not US as well, but there have been so many successful exits. And in terms of a lot of companies like Indian unicorns, they're flipping back to India from Singapore, from US to list domestically. So as a result, a lot of employees working for these successful companies have had the chance to experience liquidity. So like for Qapita, we have a platform, we run a lot of liquidity programs, so we see a lot of this activity. But when you look at the liquidity value of employee liquidity since 2020, that's a pretty healthy number. So a lot of employees actually expecting to get employee equity or ESOPs, stock options, which is a pretty common and popular way to design your program in India, participated both in unlisted space and also obviously when you're listed companies with more regular exercises. What I thought would be interesting to kind of share with you as the audience here today is that we work with a lot of companies, on our platform. We have a consulting practice where we kind of interact with issuers when thinking about how to design, how to communicate. And we'll pull together some stats from last couple of years in terms of when employees tend to kind of be communicated from the company's perspective in this part of the world. And when you look at the chart, it's very colorful because it's kind of all over the place, right? So Nicholas, you were kind of talking about, in the context of some jurisdictions, you may be expecting a lot of transparency, and that's a given, right? Like as it was the case in Norway. In a lot of countries in Asia or Asia Pacific, it may not be the case. So we see a lot of positives when you chart. Like a lot of companies, like 18% start communicating during hiring. So as part of recruitment, you start communicating what equity means, how the plans are designed, what it means for individuals in terms of communications. A lot of companies communicate, and HR provides that education, when you join the company as well. But when you look at it, 42% of the companies still only communicated kind of like whenever you give away grants. So you get your offer letter, you accept it, and then you kind of just move on, right? And there's not as much communication happening. So there's still a lot of work to be done, right? So I guess the takeaway here, when you think of it, it's important to consider the macro environment of the industry, what employees used to, what they expect as well, and then also how you may want to adjust your strategy. How do you want to communicate equity? When do you want to do it as well? So it's important to kind of get that on the ground understanding, because then when your plan is going to be successful, there's no point giving them equity if you're not communicating it, and then employees don't understand it, don't value it, and just resign and forfeit everything. Then what's the point of going through the entire thing? So I think a bit of a call to action is, doing a bit of homework for the jurisdictions when you may have a team in, especially maybe important if your company is going through like M&A and acquiring a business with a team and a jurisdiction you're not currently covering. So it's important to understand, what does it actually mean for our existing program? How can we adjust it? Do we need to change anything? Can we roll it out there? And what will our employees should be expecting in terms of communication? Um, but yeah, RJ, I guess, Asia, some countries where equity is still becoming the norm, maybe not so much. Obviously, Australia has been around for a while. I mean, North America, like UK and Australia, have been leading the way in kind of equity compensation for decades. But, there's still a few, I guess, tricky challenges to keep in mind. So what are you seeing from your perspective, like based on your experience in North America?
Yeah, thank you, Mitt. Let's talk about that a little bit. Similar to the Nordics, U.S. And North American companies or employees, they are expecting equity to be part of their compensation package. It's really kind of the norm, especially for public companies, even for private. But this is how you attract, this is how you retain using the equity, and it's part of the norm now. As far as it's always for the executives, the C-suites, a lot of the VPs, but you're seeing more and more companies, like how far down the chain are they granting equity? But it seems like more and more employees are expecting that, and having the understanding around equity and what it does for their future. I think the key word is that as any employee expectations is that transparency. I think that's for all from anywhere on the globe, but communication I think is a key point here, and I think it's important from like to look at where is that communication coming from, what are the triggers for the communication, how often are you communicating, and what channels are you communicating? So for employees from a company, you might have your own internal communications, but it's good to look at your equity platform that you're using. What communications are they sending automatically that can help you with your communication plan? So maybe that equity platform can take some of that work or burden off you. But it's also there can be maybe too much communication as well. So it's finding that right amount of where a participant or employee is just not going to ignore emails or notifications because they're getting so many. I know we had one example where we were working with a client and we were sending out the notification for their ESPP plan for their upcoming enrollment, maybe a week or so before their ESPP enrollment period, which at that point participants wouldn't read the instructions very well. They would go in to enroll and they couldn't enroll, and which generated a lot of participant or employee questions. So simply changing that timing to send out the communication until right at enrollment significantly reduced a lot of those participant questions. So having a look at that timing of kind of when those communications go out can also ease administrative burden. So there's those things to consider. I think employee education is also it's becoming like very important for these employees. And some companies do a really terrific job, and some companies have some opportunities to maybe do a little bit better job. But I think this is the communication or the education has a couple areas, and this gets into a little bit also more plan design. A really complex plan will also, and you see this a lot more with employee stock purchase plans, is if you have a really complicated plan, you have it can impact your enrollment percentage, or and so that's something to consider, is like how complex, what is my employee base? That can have an impact as well, my employee demographic. So and kind of really how you design that education. We're seeing a lot more requests from our clients for webinars, employee education webinars. So that's something that we're doing a lot more of. And it's usually plan specific or equity type specific that these employees are needing. So the education, I think, is very important, and to consider the demographic of your equity population, the complexity of your equity population or your equity plan, and to tailor it towards that. We're also seeing a lot of requests for tax advice. We get this a lot. And we have to be careful here as administrators. So most of the time our kind of set responses, here's some education materials that you can read over or talk about, but see your tax advisor. That's kind of a common response for the employees to receive, but they are looking for that tax advice. And I think having the right tools and education around the taxation for their equity will help them make sure they're understanding their tax obligations. What are the triggers or events that are creating taxable events? And then building that advice or the material around the demographic of your equity population and your awards. So that's an important one, the tax advice. There is that demand out there by the employees. I think you just have to be careful of kind of how far you go with that tax advice, and have some resources for them to help them understand. And then another one, I think this is also like not only employees, but investors in the shareholders is, and this gets into that transparency as well, is that the decision makers for the company are being compensated based on the performance of the company, compared to, I know, a while back, there wasn't so much of that. And so it didn't matter really how the company was doing. The decision makers would still receive large award payouts and things like that. So I really the performance awards really help that pay versus the performance of and that transparency and so I think it's an important one. So that's a really just I think for the North America is really just the communication and the equity is going to be part of their package. And I think we can move on. All right. Next, we're each of us going to talk through some the vesting and taxation practices.
Yeah. In the Nordics, I mean, the general theme is that income tax is quite high. So with the socials and everything, income tax goes above 50% as well. That means that that means that that means that that also goes for any equity schemes and especially when it's a listed scheme. So if you're a non-listed company that offers, for example, stock options to your employees, you might get a bit of a deferral, if you want to call that, or easement to the taxation. But stock listed or listed companies with stock options or any equity, LTI, STI plans, as Amit mentioned, those are really highly taxed. When it comes to Sweden, I think most of the Swedes are really familiar that, okay, if I receive any income from an listed company, stock option plan or an equity plan, I might get really highly taxed. And then, of course, if you fall under the KTA, as mentioned, where you have those employee stock options, you might get a deferral into the future, meaning that you don't have to pay until you actually sell those off. But in general, for all those countries, what we see is that you get taxed on when you actually receive something into your account, which is an expectations also from the employees on that part. When it comes to Norway, similar story. Taxation is quite high, and of course, if you're a company similar to Sweden as well, you might have to pay for the social security obligations that you have as a company. So then, of course, as mentioned, if you're a startup company, qualified growth companies can completely defer all taxation until the employee disposes of the shares. So similar to Sweden, it's actually the disposal part that is the sort of taxation part. Denmark, I would say the 7P is if you're a Danish company, you're going into the Danish market as a company, 7P is really something that you should go into. That means that you actually can lower and defer the taxation of the employees. So executing a formal Section 7P agreement at time of grant can completely bypass salary tax. So taxation is actually pushed from the top tax, which is 42%, down to 27%. And that therefore 7P is something that is really expected also from the employees on that behalf. In Finland has come a bit later into the game, where I mentioned Sweden and Norway being countries where the income tax or the startup companies and the non-listed companies have been able to defer tax. Finland actually applied such a legislation in 2025, meaning that similarly, you don't have to pay for the tax once you receive the options. So before that, any stock options that you received in non-listed companies, you had to pay tax for them once you received them. And well, lastly, the listed penalty, maybe going back to Sweden, Norway, and Denmark and that part as well. So if you're a listed company, you cannot bypass that tax in any way. So it's a high income tax. Then probably sort of a minor expectation from the Nordic companies is that Nordic employees actually expect that they receive their, if it's a stock option, whether it's a listed company share, that they receive them into their own accounts. And in Norway and Finland, if you would work for a company where the listing might also be Norway or Finland or any other Nordic company, you might have to have those shares by legislation in your own account. So quite similar by country, but high income tax is the thing to mention here.
Yeah,
Thank you.
important to remember. And I guess just to cover what's happening and I guess what we're seeing in Asia and kind of more broadly across the world, I think it's important to kind of start high level and just provide additional context. So a lot of kind of companies, especially kind of startups in this part of the world, could be Australia, could be Singapore, could be Middle East as well. a couple things we're technically seeing is that you maybe start building your business as a startup for a local market, but eventually you're going to start expanding internationally. So Europe, UK, US is a common, pathway for a lot of companies to follow in terms of the market sizing. So that's why we see a lot of companies setting up holding companies in like Singapore, BVI, Cayman, maybe potentially flipping to US and setting up Delaware C Corp as well. And I think it's pretty important to keep that in mind in the context of employee equity plans and programs, because and Nicholas, I'm sure that you see this a lot, but a lot of companies just go and pick up the stock plan design that RJ would see on a day-to-day basis with your kind of ISO non-qual and then your 10-year kind of a term that's by default. But a lot of these things may not make sense in other parts of the world, so you need to have a little bit more flexibility. Like Australia allows 15-year deferral. So if your plan life is, limited to 10 years, you're not actually taking full advantage of the tax code as well. Section 4A is obviously important to keep in mind, but a lot of countries in Asia allows you to give nil cost or discounted options. So for that reason, it's important to think about from the quantum and the pool sizing and all the other elements that come into play as well. So for that reason, it's kind of important to understand your organizational structure, which is the holding and issuing company as well, and obviously understand the local nuances. We talked about Philippines, China, Vietnam being problematic for international companies to issue equities. So it's important to consider. India, Malaysia, they have specific legislation or the rules around how fair market value should be calculated in those jurisdictions. So if you're a listed company, you're used to using like closing price, open market price, volume weighted average price, you might need to adjust those approach in your system or the platform you're utilizing in those specific jurisdictions. Valuation requirements, foreign A is relevant for employees in US, merchant banker category 1 is important in India. There's other jurisdictions as well. I think the other element, and when we talk about taxation, a lot of countries have this provision to be able to defer tax due to like selling restrictions, or sometimes it's called deferral period, moratorium period. It's important to keep in mind that it's not being consistently applied in a lot of jurisdictions. So, example, in Australia, Singapore, it's possible to defer tax until such time that restrictions are lifted. But for example, in Indonesia, that doesn't work that way. So your tax code and tax regime can be a little bit inconsistent. So when you think about your plan design, it's always important to consider all the local nuances in different jurisdictions. And when we think about liquidity and kind of how the tax works, once again, sticking with the example of Indonesia, your tax on, effectively exercising or selling your shares as a private company is very different to the public. So you're going to have effectively a lot more friendlier regime if you're transacting your public company shares as an Indonesian employee. And on the flip side, there could be some jurisdictions where your capital gains tax regime is very different. So in Singapore, no capital gains tax, so just income tax. So all these things are important to consider for you to design it. So let's have a look at like what it looks like in practice and some of the things to keep in mind as a company on a day-to-day basis. So what we kind of see in terms of the vesting and taxation kind of stats, we'll start with Australia. So Australia kind of sees more your vanilla 4-year, kind of 1-year cliff. That's pretty standard. A lot of companies are going with sort of equal vesting over the period of time. Some companies kind of follow more like Amazon, the 10, 20, 30, 40 kind of style. But usually you don't see much variety there, and it's pretty standard. Australia has some tax advantage plans, like deferred salary sacrifice plan, but it's not very popular, to be honest. A lot of companies kind of follow with more global international ESPP style, especially matching plans are very popular for Australian companies. In Southeast Asia, we actually see a lot of companies going to like more your monthly vesting. So a little bit more flexibility, a bit more employee friendly. We know it's actually not the trend in other parts of the world. So a lot of countries are actually moving away from monthly to quarterly to a little bit more structured. I think because we want to incentivize a lot of employee equity participation in Asia, we're seeing a lot more friendly designs. At the same time, on the right-hand side, we're looking at the stats of inclusion of performance conditions in different jurisdictions. And this is across hundreds of companies that we work with as well. So a lot of companies do embed some performance condition or hybrid designs. When you look at Southeast Asia, the numbers are a lot lower. So predominantly time-based, 91% of the companies here are offering time-based plans. So your design implementation also needs to be localized as required. And In India, similar kind of trends. Important thing to consider for India, if you're an Indian company, you must have a 1 year cliff. So it's not possible to have a shorter vesting in time, which is more flexible in other jurisdictions depending where your company is registered. But yeah, look, so this is a lot of nuances everywhere. We also work with a lot of North American companies, but RJ, I know you're seeing a lot of insights and trends. What would you like to highlight with us for US and Canada?
Yeah, yeah, thank you. Um, for the vesting and taxation in North America, we are first just want to talk through some trends that we seeing. We're seeing a lot of the companies move away from period end vesting dates. Um, and this helps in several ways. And the main reason is having activity at a period end, either month end or quarter end, or even year end, can delay um, that period being closed out for typically accounting reasons. And so we are seeing a lot of companies to move away from that. It also for any type of share or wire reconciliation, the activity completes in that period versus a crossover. So we are seeing that trend in the industry. Um, just a client that I'm working with right now, they have made that decision, and they are moving away from period end, but they still have a couple years of vestings left that they do have period end. So they're in that transition period. Um, we also are seeing clients move away more with stock options. We're still seeing monthly vestings, but really for any RSUs, PSUs, we're not seeing monthly vestings much anymore, or any new grants are not going to that. And I know there was research done that from an employee's perspective, it wasn't going to impact their retention, whether they're going to stay with the company if they have monthly vestings versus quarterly. So it's the administrative burden doesn't really give the any type of advantage there. So it's one of the reasons. We're also seeing new hire grants moving from a or higher date as their grant date to a common grant date that either occurs the next month or the next quarter. And the reason for that is you'll see maybe an older company that was doing that they have 10 new hires in that month, and then they all have different hire dates, and then the next year's RSU release, they have 10 different vesting dates that month, plus all the other new hires from the previous years that had different. So you could have 10 to 20 different RSU releases for that month, which is a tough and challenging administrative burden compared to more of a common grant date with the corresponding common release date. So certainly a trend in the industry there. This one, the release fair market value for tax calculation, we're seeing a lot more companies move to prior day close for that fair market value for that calculation compared to current day close. I was looking at the NASPP survey, and in 2022, only 19% of companies were using prior day close. Now, as their 2025 survey, a little over 30% of clients or companies are using prior day close. And it helps in a few areas of using that prior day close. I know I mentioned previous slide, but it does help with the IRS next day 100K rule. You have more time to calculate. For your payroll team, it gives them an extra day to make sure and audit the taxation, and gives you even another 24 hours for preparing and any Section 16 filing forms. So just in general, it does help with administration in several areas. A lot making that change if you are current day closed to make that change. There's certainly some things to consider with reviewing the plan docs and understanding the language and but a lot of times they're around the fair market value for um, the tax calculation on releases. That language is vague and so not as difficult to make that change. Tax withholding method, the majority still is netting shares with tax. But I think we are seeing more and more clients look at sell to cover for their tax withholding method. And really that third method is the individual paying cash for their tax. Typically, we're only seeing Section 16 or high executives elect to pay cash so they can get their full shares. But that's typically the three different tax methods we're seeing. But I think just even though these companies are based in North America, or I'm talking about, but a lot of them do have international participants with equity, and I think as an administrator, that is really a challenging piece, especially if you're not used to administering international populations. Um, there are a lot more considerations with that with administration. You're going to have potentially different payroll contacts. They're going to be on a different payroll system. And how or if you're going to tax them. Sometimes you might leave that tax burden on the employee themselves to handle, and sometimes you might try to administer that yourself. However, it is very important to maybe have some type of resources to understand these different international regulations as we're talking through today. They're very different on what you can even offer, and so I think we're all kind of talking about the same thing here, but it's when we are working with international everything participants or international countries and really diving deep and understanding all the rules and regulations for those different countries is important. I think also on the U.S. or North America is even probably for global here is the equity platform tax calculation support. So a lot of the platforms do offer this support, but it's really getting the data into the system accurately for it to tax correctly. So bad data in means bad data out. So that is a big administrative part of stock administration if you are using the platform for taxation to make sure that all the tax jurisdictions are set up in the system. And for the US, we do see a lot of clients automating some of that directly from their payroll with their year-to-date and supplemental to make sure that the tax is accurate and up to date. So, any final comments, Amit or Nicholas?
I think that's plenty of content for everyone to digest. I guess, your closing comments are probably the keys that, every single equity program we see, no matter where the company is increasingly more international. So it's always important to just be prepared and, understand the local nuances. And look, you can definitely get a lot of help. I'm sure like all three of us are happy to chat with anyone if you have any questions for the jurisdictions we've covered. I know there's a lot of countries we didn't touch on, but doesn't make them any less interesting or quirky. So yeah, I mean, that's why we're in the jobs, because it's a very interesting industry, and then a lot of different rules. Yeah, no, so I enjoyed the chat. So RJ, thanks for hosting us as well. And yeah, Nicholas, any closing comments from you as well?
No, I agree. That's a great conclusion. And although I think there are sort of differences between the countries or the jurisdictions or places that we just discussed, I think there are quite a few similarities as well. So
There you go.
Yep. Well, thank you both for attending
no,
and helping out today. It's been great working with the two of you. And thank everyone for joining.
Yeah. Thanks all. Have a great one.
Yeah.
thanks.